Hello friends, welcome to AS27. Last few paragraphs, the important part we have covered. Paragraph 14, investors share in negative net worth of joint venture. In a joint venture, there are two types of stakeholder. One are called venturer. Venturer are the parties who have joint control over the venture, and there is another party who is called investor. Investor is a party to joint venture, but it does not have joint control. He is more like a passive investor. He is more like a sleeping partner. In case of joint venture, he is interested in providing fund and getting dividend or return, but he does not participate in the day-to-day operations. Now, it is possible that the joint venture may have incurred losses. If joint venture incurs losses and the share of the investor becomes negative, because investor will also get a share in the losses, the share in negative net worth losses equity of the joint entity which belongs to the investor. Now, what is the maximum loss the investor would suffer? Let us start from the basics. The maximum loss the investor would suffer is his investment. But if the share in the negative net worth, that is losses, exceeds equity of the joint entity which belongs to the investor, so investor's share of losses, because investor will not pay anything more than whatever capital he has contributed, his share in losses will be apportioned between the venturers proportionately. His share in losses will be apportioned between venturers proportionately when the venturers would be preparing their consolidated financial statement. The reason is investor will not bear losses more than what he has contributed. Therefore, his share in losses will have to be borne by the venturer while preparing the consolidated financial statement. But there is an exception, unless the investor has a binding obligation to and are able to contribute for the losses. But if the investor has made some kind of obligation and is able to make good the losses, then the investor loss will not be recorded in the consolidated financial statement of the venturer. So, the summary is that if the investor has losses, his losses will be recorded by the venturers proportionately. Logic, investor will not pay for more than whatever capital he has contributed. Liability of equity shareholder is limited to the extent of the capital, nothing more than that. However, if the investor has given guarantee or has entered into any kind of commitment or obligation, and if he is able to make good that, then we are not going to record the losses of investor in the financial statement of the venturer. So, your question could be, do we have any example on that? Yes, we have an example, but good news, there is no numerical question on this. So, I will read the example number 4 in your book. A joint venture in which there are two venturers with a share of 40% each and one investor has a share of 20%. So, this is JV. There are venturers and there is one investor. There are two venturers, let us call them A and B, and there is one investor, let us call him C. Their share is 40%, and investor share is 20%. When the share of loss of investor exceeds 20%, when the share of loss of investor exceeds 20%, let us say 10,000 rupees, his share of loss exceeds 20%, and let us call it 10,000, then this 10,000 loss will be recognized by each venturer. So, 10,000 loss will be recognized by both the venturers proportionately. In this example, proportionately means in the ratio of 40:40, and therefore each venturer would recognize a loss equal to 5,000 each. That is the meaning of this paragraph number 14. Come to paragraph 15. This is important for a theory question. Write down important for theory question, and this question is there in your book also. Refer question 17 at the end of the chapter. Refer question number 17 at the end of the chapter. So one question we are discussing right now: when is a venturer required to discontinue the use of proportionate consolidation method? So a venturer would discontinue the use of proportionate consolidation method from the date it ceases to have joint control. What is the basis for AS27? The basis of AS27 is joint control. If that joint control is lost, AS27 is not applicable. Second is the joint entity suffering from severe restriction which significantly affects its ability to transfer funds to the venture. The same point was covered in earlier discussion also. If you have suppose a joint venture entity in a foreign country, let us say Afghanistan. Afghanistan is controlled by Taliban, and now the Talibani government has banned remittance of funds. This joint venture entity cannot remit funds to the venturer. If that happens, then you will stop applying AS27 proportionate consolidation method. Then what you will do? Now if suppose you had joint control, but now you have acquired control, your stake was 50%, now your stake is 70%, you acquired 20% more, so you will not apply AS27, but you are going to apply AS21. Now you have become parent, the other party, other entity is your subsidiary, you have unilateral control and you will apply AS21. Second possibility, you have lost control. Now you don't have control, you don't have joint control, you don't have significant influence. Then you will just apply accounting standard 23. Another possibility, earlier you had joint control, now you have significant influence. You have given up joint control and you are saying that I am happy with just being an investor. Now I cannot participate in the financial and operating policy decision matter. I just want my dividend. So, but I will exercise significant influence. Wherever necessary, I can participate in the policy making process, but I don't have joint control. You will apply accounting standard 23. So the relationship between the investor and the other party now changes to investor and associate. You will start applying AS23. Now the question will be, what would be the carrying amount of investment once you cease to have joint control? So there is an answer for that question. Underline, for this purpose cost of investment should be share in net asset on the date of discontinuation. So you will calculate your share in net asset of the joint venture on the date of acquisition after adjusting carrying amount of goodwill or capital reserve. So the carrying amount once you cease to have joint control will be equal to share in net asset on the date of discontinuation. You will calculate the net asset of the joint venture multiplied by your share plus goodwill, but if there is a capital reserve, then minus capital reserve. If goodwill is there, Add goodwill if capital reserve is there, minus capital reserve. This will become the new carrying amount for the further application of AS 23 or AS 21, okay, or AS 13 in the consolidated financial statement. Next point, different reporting date. We have covered the same paragraph in AS 23 also and AS 21 also. Ideally, the joint venture entity and venturer should have same reporting date, but practically it may not be possible. Joint venture may be in a foreign country where the year ending date may be December or September. In India, the year ending date is 31st March. So if there is a difference in the reporting date, joint control entity year ending date is 31st December 2025. Venturer year ending date is 31st March 26. So what they will do? They will give the effect of significant event or transaction. If there are significant event or transaction which have taken place between 31st December 25 and 31st March 26, they will give the effect of significant event and transaction. That means take this balance sheet and whatever significant transactions have taken place between these two dates, you will give the adjustment effect plus minus whatever, okay. And the standard says in any case the gap should not be more than 6 months. In any case the gap should not be more than 6 months. So the maximum gap permitted between the year ending date of the jointly controlled entity and the venturer is 6 months, and the year ending date of jointly controlled entity should be before the year ending date of the venturer. Again the same paragraph we are repeating for the third time, AS 21 also, AS 23. Wherever possible, the jointly controlled entity should follow uniform policy, that is the policy followed by the venturer. But practically sometime it may not be possible. The jointly controlled entity may be in a different country, let us say USA. So they may be applying a different set of accounting policy, whereas Indian venturer may have a different set of accounting policy. So ask your jointly controlled entity that please prepare financial statement as per our policy, but that may not be possible. Then the standard says if you can't follow same policy, make adjustment for those items where different accounting policies were followed. If suppose adjustment is also not possible, then give disclosure. So point number 1, ideally follow same policy. If that is not possible, make adjustment. If that is also not possible, give disclosure in the financial statement. Paragraph number 18, if jointly controlled entity itself prepares CFS, A Limited is a venturer. It is a venturer in a jointly controlled entity. This jointly controlled entity has a subsidiary. So first this subsidiary will be consolidated with jointly controlled entity, and you will prepare CFS of jointly controlled entity. So this jointly controlled entity will first prepare consolidated statement, and this will be used by the venturer for the purpose of consolidation. If JC itself prepares a CFS, then CFS will be used by the venturer for presentation of CFS. But we don't have any numerical question on this. They will not ask you also, because it will become a little complicated, which is not in the scope of our syllabus. Only for theory question. If the JC prepares CFS, you will use the CFS of the JCE for the purpose of consolidation. Numerical question or case study is not there. Now the institute can ask you this paragraph transaction between venturer and joint venture in a consolidated financial statement. There can be transaction between venturer and joint venture. This we have also covered in AS21 and AS23, where there are transaction between parent and subsidiary covered in AS21, transaction between investor and associate covered in AS23, and similarly there can be transaction between the venturer and the joint venture. Then there are two possibilities. First is venture contributes or sells asset to joint venture. Second situation is venturer purchases assets from joint venture. Let us look at left side of the screen, printed in your book also very nicely. You have to just keep this in mind. If venturer is selling to joint venture, there are two possibilities: profit or loss. If there is a profit, suppose cost is 100, sold to 150, but you are one of the venturers in joint venture. Let us say you are holding 50%. So out of 50 rupees profit earned by venturer, this profit is actually made by one, transacting with yourself, because you are a 50% owner in that joint venture, and 25 rupees profit is made by transacting with other venturer. So what the standard says, to the extent you have made profit by transacting with yourself, because this is venturer, this is joint venture, you are 50% owner in the joint venture. So if you are selling to joint venture, you are making profit from yourself. So don't recognize your share in profit till the goods or the asset is sold by the venturer to a third party, but you can recognize the share of profit of other venturer. Okay, so recognize only that portion of gain or loss which is attributable to interest of other venturer. So in this example, suppose venturer sold goods costing 100 rupees at 150 to joint venture. Venturer is holding 50% share, goods are still unsold. You are going to recognize a profit of only 25 in the consolidated financial statement. Remaining 25 you will recognize when goods are sold to third party. And what about the loss? Recognize full amount of loss when evidence provides reduction in NRV or impairment loss. In case of loss, we have to be conservative. If the loss is due to reduction in NRV in case of inventory, or if the loss is due to impairment loss in case of asset, PPE, intangible asset, then we can recognize full loss. But if the loss is not due to fall in NRV, not due to impairment loss, then you will not recognize your share of loss. You will only recognize the share of loss of other venturer. This is situation 1. Same situation here also. Joint venture sells goods to venturer. Who has made profit? Joint venture. You are one of the venturers in joint venture. So when joint venture makes profit, suppose 100 rupees profit, 50 belongs to you only, because you are a 50% suppose venturer in that. So the standard says do not recognize your share of profit unless the goods or the asset is sold to an independent third party. In case of profit, do not recognize your share of profit. And in case of loss, do not recognize your share of loss. However, in case of loss, we have to be prudent. If the loss is due to fall in NRV or if the loss is due to impairment of asset, then full loss can be recognized. Now we'll give you some example to understand. On the left side, when goods are sold by venturer to joint venture, numbers will help you to understand. Venturer A and B jointly control JV, each have 50% share. A sells an equipment with a book value of 50,000 to joint venture for rupees 80,000. So cost is 50, sold for 80. So profit made is 30,000 in this deal, but out of 30,000, 50% belongs to other venturer 15,000, 50% belongs to you, that is 15,000. Only 15,000 profit will be realized and 15,000 will be unrealized. So while preparing the balance sheet, now understand this part, your institute will not explain. You have sold asset costing 50,000 to 80,000. In the books of joint venture, asset will appear at 80,000. When you will do proportionate consolidation, you are going to record your share in the asset of joint venture. In proportionate consolidation method, we record our share in the asset and liabilities of joint venture. So we will record the same asset again while doing proportionate consolidation. 40,000 minus unrealized profit 15,000. So the answer is the asset will appear in our consolidated financial statement at rupees 25,000. Same thing here also. Now this is situation 2. Joint venture sales to venturer. Example, X is a co-venture in a jointly controlled entity to the extent of 40%. During the year, X purchased an asset from jointly controlled entity for rupees 15 lakh. WDV is rupees 10 lakh. In the CFS of X Limited, the share of profit attributable to X Limited is treated as unrecognized. Therefore, from the carrying amount of the asset, rupees 2 lakh, which is 40% of 5 lakh, will be deducted. So I am going to now give you the presentation in the balance sheet of X for situation 2. How the asset will appear in the balance sheet. Cost of the asset in the books of X, they have purchased it for 15 lakh, but it includes unrealized profit of 2 lakh less unrealized profit 2 lakh, and therefore you are going to eliminate that 2 lakh, and now that asset will appear at rupees 13 lakh, because you are one of the venturers in that joint venture. Unless the asset is sold by you to a third party, your share in profit will not be recognized. So one effect will go to asset, and of course the other effect will go to consolidated profit and loss account. So this is how profits are eliminated in the consolidated financial statement. Now listen to me carefully this line. In case of transaction in a jointly controlled entity, the earlier requirement should be applied only in preparation and presentation of CFS. If it is a jointly controlled entity, then the elimination of unrealized profit will be done in the CFS only. But in the separate financial statement, full profit and loss will be recognized. So I will summarize for you. If joint venture is JCE, if the characteristic of joint venture is JCE, in CFS, unrealized profit or losses will be eliminated. In CFS, unrealized profit or loss will be eliminated. However, in SFS, full profit or full loss will be recognized. If it is jointly controlled entity, then the elimination of unrealized profit or loss will be done in CFS. In separate financial statement, full profit or loss will be recognized. If it is JCO or JCA, unrealized profit will be eliminated in SFS. I repeat, if it is JCO or JCA, unrealized profit will be eliminated in SFS. But if it is JCE, the unrealized profit will be eliminated in consolidated financial statement. For JCO and JCA, there is no new entity created, and therefore whatever adjustment we have discussed will be done in SFS. Automatically, if you are preparing CFS, it will get transferred to CFS also. But if it is jointly controlled entity, the elimination will be done only in CFS. In our book, there is one question number 1. Please come to question number 1. On the question answer part, after 2 pages, you will see A and B are co-venturer in a joint venture C to the extent of 30% and 70%. During the year, A sells a plant WDV 40 lakh for 50 lakh to C, and thus making a profit of 10 lakh. How will this be recognized by A? Now this is A, this is B, and a new entity C is created. So this is a question of JCE. This is a question of JCE. So our answer will be in SFS, full profit of rupees 10 lakh will be recognized, and in CFS, what is the share of other party? 70%. So 70% of 10 lakh. In CFS, 70% of 10 lakh, 7 lakhs will be recognized. Rupees 3 lakh unrealized profit will not be recognized. Will not be recognized. Rupees 3 lakh unrealized profit will not be recognized. And suppose you are preparing the consolidated balance sheet of A. In the consolidated balance sheet of A, asset will appear. This is 50 lakh in the books of joint venture. So 50 lakh into your share 30% in the asset, 15 lakh. But you are going to eliminate unrealized profit equal to 3 lakh. So therefore, this asset will appear in the balance sheet at 12 lakh only. This asset will appear at 12 lakh only, and 3 lakh unrealized profit will be reduced from the consolidated profit and loss also. So that is how the answer will be presented by the student. I have also given you the presentation of the balance sheet. Let us try one more question. Question number 2. In case of above problem, what would be the treatment if the transfer price was only rupees 35 lakh? So there is a loss. Okay. Book value is 40 lakh. Sale value is 35 lakhs. So there is a loss of 5 lakh. So what will be the treatment in the books of A? That is the question. What will be the treatment in the books of A? So if in SFS of A, full loss of rupees 5 lakhs will be recognized. In SFS of A, full loss of rupees 5 lakh will be recognized. In CFS of A, now there are two possibilities. Loss is due to decline in NRV or impairment. The loss is due to decline in NRV or impairment. Then you will say full loss of rupees 5 lakh will be recognized. And the second possibility is loss is not due to impairment. Then recognize loss of only 70% of 5 lakh, 3.5 lakhs. Unrealized loss will be 1.5 lakhs. Unrealized loss will be 1.5 lakh. Question number 1 and question number 2 was venturer have transferred asset to joint venture. Now let us take question number 3. In question number 3 it is reverse. So we are also going to take question where joint venture sells to venturer. Student will come to question number 3. X is a co-venturer in a jointly controlled entity to the extent of 40%. During their X purchased an asset from jointly controlled entity for rupees 15 lakh whose WDV was 10 lakh. This example we have already discussed on the previous page. What would be the treatment in the books of jointly controlled venture and X? So first is in the books of jointly controlled entity, full profit of rupees 5 lakhs will be recognized. There is no problem. Joint control entity will recognize full loss. But in the books of X, who is a co-venturer, unrealized profit equal to 40% into 5 lakh, that is 2 lakhs, will be deducted from asset in the consolidated balance sheet. Will be deducted from the asset in the consolidated balance sheet. So this example we had discussed also, and one more example we'll take of loss. In case of above problem, what would be the treatment if the transfer price was 8 lakh and the jointly controlled entity incurred a loss of 2 lakh? So in the books of jointly controlled entity, you will say full loss of rupees 2 lakhs will be recognized. In the books of X Limited, who is a co-venturer, there are two possibilities. So I will write here is the loss due to fall in NRV or impairment? Is the loss due to fall in NRV or impairment? The answer is yes. Then no need to recognize unrealized loss. No need to recognize unrealized loss. No need to recognize unrealized loss, which means entire loss will be recorded, no adjustment required. In bracket you can write no adjustment required. No adjustment required. But if the loss is not due to decline in NRV or impairment, then unrealized loss of 40% of 2,80,000 will be added to asset in consolidated balance sheet. I repeat, if the answer is no, unrealized loss of rupees 80,000 will be added to the asset in the consolidated balance sheet. So today you do two homework, question number 5, 6, 7, 8. Question number 5, 6, 7, 8 homework. Question number 5, 6, 7, 8 homework. Probably 6 is not typed there, ignore it. So solve the remaining question as homework. We have covered the entire syllabus now. 5th number is same problem, 7th number is same problem. Now you come to paragraph 21, investors' interest in joint venture. If you are an investor, not a venturer, you have only supplied capital, then you need not apply AS 27. Investor will not apply AS 27. Then what the investor will apply? Depending upon what is the connection between investor and this joint venture. If he is just an investor without any special rights, he will apply AS 13. But if he is an investor and holding more than 50% share in voting power, he will apply AS 21. If he is an investor and having significant influence, then he will apply AS 23. But in separate financial statement, the investor is always going to apply AS 13. So in SFS always AS 13. In CFS depends, if you have control AS 21, if you have significant influence AS 23, if you have nothing then AS 13 only. Next point is operator or manager. One or more venturer may also act as an operator or manager in joint venture. That means they are putting their time, energy, effort in the joint venture. They are like active partner in partnership, and for spending their time, energy, effort, they will get remuneration in the form of fees. Okay, like in your partnership chapter, the active partner gets remuneration. Here also, out of so many venturers and investor, the one who is managing on a day-to-day basis the affairs of the joint venture, he will get a fees. Accounting of that fees or commission received by the venturer or the operator will be done as per accounting standard 9, revenue recognition. Okay, in the books of joint venture it will be shown as an expense, in the books of venturer it will be shown as income. And now we'll come to the last part, then you will study the chart that I have given to you below for your more conceptual clarity purpose. So disclosure requirement is, one is about contingent liability. So venturer would disclose separate from its own contingent liability incurred by the venturer for joint venture. So whatever he is responsible, whatever contingent liability he might be responsible for, disclose that. He has to also disclose the contingent liability which he has jointly incurred with other co-venturer. If the joint venture entity also has a contingent liability, then your share in the contingent liability of the joint venture. And fourth, those contingent liability which arise because venturer is contingent liability for the liabilities of other venturer. So if you are liable for the liabilities of other co-venturer also, give disclosure of that. And similar disclosure is for capital commitment. Commitment to purchase capital good, commitment to buy capital good. So you will disclose, in addition to your own capital commitment, the capital commitment which is incurred for joint venture, share in that which is incurred with other co-venturer, and share in the capital commitment made by the joint venture. So this is the disclosure requirement for capital commitment. And in addition to these two disclosures above, you will disclose list of all joint venture. All joint venture that you have, give a disclosure, description of interest, that is up to describe about that joint venture, your stake in significant joint venture. In case of jointly controlled entity, it should disclose proportion of ownership interest. You have to also disclose how much percentage you are holding, name and country of incorporation or residence. In the separate financial statement, the aggregate amount of each of the asset, liability, income and expense relating to its interest in joint venture will be disclosed. So these are the disclosure requirement as per AS 27, and with this we will come to an end of this very wonderful standard AS 27, very important for the exam. Please revise all questions again and revise the theory part again. You will be able to solve almost every question in the exam. So thank you very much. Bye bye.